Hi everyone, Richard Vaughan, a financial advisor at Ashford Wealth Advisors here. Joining me is Calvin McLeod, our Superannuation manager. And today we're just going to go through the recent changes in superannuation laws that were enacted in November of last year. The changes were fairly wide-reaching. There is a lot of detail in them. As is always, the devil is in that detail. But we'll try and get through these in as much plain English as we can. So that you've got a better understanding of what's happening in your superannuation world. We do have to obviously always preface our presentations with a warning about our advice. Basically, the advice in this presentation is all general. It's not specific to your needs or your circumstances. So please ensure that you get advice, professional advice, from either us or your other advisors if that is the case, as these changes are quite complicated and can easily cause, I suppose, mistakes to be made. So we might get stuck into this if we can. We're just going to give a bit of a background as to how government over the years has made changes to superannuation, dabbled in it. It is a big pool of money. It is a large temptation, I suppose, for government to claw at it and grab a bit more revenue through taxes, and they haven't left alone. And as the Greek philosopher said, the only thing that's permanent is change, and that's certainly true with superannuation. Kelvin, we can see here on screen a number of the different changes that have happened in previous years before 2007. The largest probably which is Paul Keating's decision to make superannuation contributions compulsory, which obviously then involved pretty much all of the Australian working public in the superannuation system. They obviously wanted to lift contributions as high as they can, and Keating certainly wanted to lift them as high as 15%. They haven't got there, they haven't got anywhere near getting there. But certainly the intent that Keating had was that people would save for their retirement and be less of a burden on age pension in the future. So he was quite a visionary at that point. But unfortunately, since then, governments have started to muck around with what was the original plan. Do you want to talk us through a bit what John Howard got up to in his day?
Yeah, so definitely. So look, obviously Keating had his vision that, and the system, ran, as it did for quite a few years. And obviously when Howard came in, he thought, well, maybe we can, maybe do this a little bit better. But obviously it wasn't as simple, and he has actually added a few changes in here, as you can see on screen. The lift was meant to go up to 15% as per Keating. Pre to 2007, that was scrapped. There's also a proposal to allow employees to opt out of the super. That was also scrapped.
That's a crazy one, isn't it? I mean, Paul Keating introduced it so that we were all made effectively to save for our retirement, and then Howard basically tried to do the opposite. Thankfully, he didn't get up, and actually allowed it to be optional, which down the track would have caused all sorts of chaos from an age pension perspective.
Well, yeah, you look at the issues we're having at the moment, 10 years on from here, and if that was to be allowed, I think the government would be having, trying to claw back even more money now. So yeah, that was crazy. One of the other big things was the Wallace Financial System inquiry. So the allowing, which, most employees now, have the choice of where their funds are going to go into, which that's definitely a great change.
And that also saw, I think, the population move towards self-managed superannuation funds, and certainly the numbers of funds since those changes through the Wallace inquiry has seen self-managed super funds grow in popularity, and now to represent more than 1/3 of superannuation accounts.
Yeah, definitely.
The other big one, of course, is the lifting of the preservation age, which we're still in the middle of. It was 55, we're now to 56. It'll slowly scale up to 60, but obviously the idea behind that is to get people remaining in the workforce and not accessing their super earlier than perhaps they should. He didn't stop there though. In 2007 with Mr. Costello as Treasurer, they introduced, in inverted commas, and they are inverted commas for a reason, a simpler super, which changed a few rules and added a few more. So I'm not quite sure of the simple part of that, but certainly they did open up the ability for people to use superannuation, or certainly get more money into superannuation a lot easier. The $1 million cap through 2007, 2008 was a big one, and the bring forward rule especially, which allowed at that point 450,000 in 1 year. They got rid of the reasonable benefit limit as well, which again, sent a message to the public that they could grow their super as much as they want and enjoy all the tax benefits that came with it. Rudd was an interesting one. He didn't do a lot. Talked a bit and did a few reviews, as you can see there, that maybe set the groundwork for some of the recent changes, arguably. But there wasn't a lot of change other than, again, he did, to his credit, propose the increase of compulsory super contributions to 12%. Again, probably seeing the writing on the wall of ageing population, was really conscious of the fact that we all need to increase our savings, and the hand in hand to that was lifting the pension age to 67, so that we had another 2 years, which we had to work before relying on that income. Gillard, what was your take on what Gillard was up to?
Well, I guess at the same time, the change in government back and forth, again, the increase to SGC, was meant to be up to 12% almost by this time. The increase was then deferred to July 2019. We've actually even seen that pushed out even further. We're only at 9.5% currently. Probably one of the biggest things that was introduced was the Div 293 tax. So what that is if you had income above $300,000, adjustable taxable income, you actually paid an extra 15% on your contributions when they entered the superannuation system, which does affect quite a few people. They also introduced the low income super contribution, which effectively is just a refund of the contributions tax for low income earners. So not a lot happened with her, but again, the Div 293 was quite a big introduction.
Yeah. So through all that, of course, they just created more and more complexity. That leaves open to manipulation, I guess, in terms of where super originally started, what Paul Keating's intent was at the start, to then what it becomes today, which is arguably a taxation, tax planning and estate planning tool. And that's where Scott Morrison and the current government certainly took umbrage to, and are keen on basically returning superannuation back to its original origins, or certainly that was their view on it. In fact, 12 months ago, we were at the Superannuation Association conference in Adelaide, and Scott Morrison was there. This is a post from our Facebook page, and he was talking about the fact that estate planning wasn't supposed to be a goal in relation to superannuation, nor was tax planning, and that's how it had got to, through no fault of the public, certainly just because of all the changes. And he sort of expressed his keenness to return to purely a retirement planning vehicle. So we left that conference in nervous anticipation, I guess, of what the budget might bring, but hopeful that the changes wouldn't be too far-reaching. I'm not sure our dreams came true, though. So we're going to run through just by bullet point anyway, just the primary changes that they announced in the budget in May 2016, and then we'll dig a bit deeper on those ones individually. So, Cal, do you want to run us through those points?
Yep. So look, so I guess the first one there on that list there is the introduction of the 1.6 million transfer balance cap for retirees. So we'll go into more depth with that. when it was first put out at budget night, they said it was only going to affect a very small amount of people. But actually, when you actually look at what they've done, they've fundamentally changed the way that the retirement system is going to work going forward. So it will affect everyone one way or the other. The next thing there is the removal of tax exemption for transition to retirement pension, which I think that's probably the biggest one there, isn't it, Richard?
Yep.
It's, there's a lot of people that are currently going to be caught in that. Next one there, the cut in annual concessional contributions to 25. As you're aware, of the last few years, that's gone up, down, left, right, depending on your age. So what's happened now is going forward, it will just be one flat cap of 25,000 for everyone. And in addition to that, they've introduced, it was meant to be from July 2017. They've pushed that back 1 year just to probably, get a bit more benefit there for their budget. But they've introduced the catch-up concessional contributions over a 5-year period. And we'll definitely go into more depth with that later. The annual non-concessional cap. So again, that's, over the journey, that's had many different forms. From $150,000 annually to $450,000 over a 3-year period, currently sitting at $180,000 per year, and $540,000 if you utilise the bring forward rule. That's going to be going in future.
So effectively, it appears like the government are actually trying to stop us putting as much super in as possible. The tax deductible cap, if you like, is gone from maximum 35 to 25.
Yep.
Which is basically a third, and then the non-concessional has gone from 180 to 100. So certainly a concerted effort to stop us saving in retirement. The end game, of course, being we hold our money outside of super and get taxed at our marginal rates rather than the favourable tax treatment of
definitely.
super.
Yep. So the next one is the spouse tax offset. This one isn't utilised so much at the moment, and that's pretty much due to the threshold, around 10,000 and facing out at 13,800. That being pushed up now to 40,000. I can see this being a big tool being used in the future. It will capture a lot more of the population. Again, previously mentioned the Div 293 tax. So this is going to affect even more people going forward because that threshold's being lowered to $250,000 going forward. As you can see there, crossed out was the removal of the work test. That's now been scrapped. That was initially mentioned on budget night, but no, it is no longer. The removal of the 10% rule for tax deductible contributions. So what that is there is, for those self-employed, if any more than 10% of your income was from salary and wages, you actually weren't able to claim a personal tax deduction in your tax return. That's being removed, but there's a few things that we'll go over with that because you've got to be mindful of. And one that most of you probably won't be even aware of is the entry detriment provisions. That's been removed going forward.
Yep. So there's some a fair number of changes in all that. As I mentioned, though, the devil's in the detail because whilst they're just lines there's some far-reaching consequences for everybody. And this one in particular is the $1.6 million transfer balance cap is one that most people would, I suppose, ignore. I don't have $1.6 million in super, so this doesn't affect me. But in reality, the mere transfer balance cap, regardless of the number, has the potential to affect many people. So it's certainly something to be aware of. So just running through the basis of this cap, basis on the balance of a member's account, superannuation account at the 30th of June 2017. And effectively what needs to happen is the ATO need to start everybody's balances at zero. So if a member has a pension account, it will have to be rolled back to accumulation on the 30th of June. And then on the 1st of July will be rolled forward to create the new pension account. That roll forward is obviously limited to the $1.6 million. So you cannot commence a pension from the 1st of July 2017 for any more than 1.6 million, regardless of how many funds you have. So this is not limited to a single fund. This covers all of your superannuation pensions. Now, obviously, some funds will have a balance that's greater than 1.6 million. And in this case, we use an example of a member fund with a balance of 2 million. Obviously, on the 1st of July, they'll roll forward their maximum 1.6 million, which is 80% of the total, into their pension, and then the balance to 400 will remain in accumulation. So what this means is that this member may have gone from having a $2 million tax-free fund to now only having a 1.6 million tax-free fund, and the balance will be now taxed at the 15% earnings rate. The cap is made up of a few different components, which we'll go through in a second. But everyone starts from zero, regardless of whether you have 1.6 or 100 or zero. You get rolled forward, and that'll use up the first part of your cap and will be the basis for calculations ongoing from the ATO. So all super funds will need to report to the ATO on what a member's balance is at any, at any particular part of the year. So that's pretty much made out like a accounting ledger. We've got debits and we've got credits. Obviously, as I mentioned, we all start at zero because we roll back any current pensions. And then when we roll forward into the new pension, that is a credit, which then comes off of your available cap. So if we use as an example, a fund worth 800,000, and we roll forward 800,000 into a pension, because the cap's 1.6, then that means they've got 800,000 left of their pension cap for later years. The debits and credits process is that, as I said, rollovers from accumulation as part of your credit. Any reversionary pensions you may receive through a member who might have passed, and earnings also make up your earnings on your excess amounts also make up your credits. To actually make some room in your cap, the only way to do that is through a lump sum payment, which commutes back to accumulation. So there's some things that aren't included in debits. Certainly, if you draw a pension, that's not included as a debit to your cap, so your cap will remain the same regardless of how much you take out in pensions. And if the value of your investments go up or down, that doesn't impact your cap at all. So, as we mentioned, the devil's in the detail, and we'll go through some, there's probably more than what we've got here, but these are certainly some of the key ones of potential traps and consequences that you might come across as part of this process. Again, not limited to the 1.6 million, because certainly some of these impact a lot of people. So your actual balance doesn't really matter. You still may get caught up in the cap process. So Calvin, do you want to walk us through the first one there, which is around Centrelink issues? Or we might actually just run through these in bullet points, and then we'll go into them in a bit more detail.
Yep, so obviously the first one there's potential trap and consequence there of the Centrelink issues on commencement. So obviously there's different treatment of pensions that were commenced post 1st of January 2015. Because the government are actually, they're saying that you've got to physically, with an accounting entry, roll back that pension and commence it again on the 1st of July. Look, we haven't read anything yet, have we, Rich, that says that this isn't going to be the case, but we think that that this is going to form part of a new start date. So really everyone's going to fall under these new Centrelink rules. So I guess that's what I mentioned at the start. Yes, it is a $1.6 million cap, but regardless if you've got $100,000 in pension or 1.6 million, this is one of the potential issues that it's going to be far-reaching.
So basically, anybody who's currently receiving an age pension from the government and has a account-based pension in superannuation may find that, without knowing it, that they may be caught under this and may have their age pensions impacted. In a negative way, of course.
Yeah, we hope that they see this as an issue and do make some changes there, but we haven't read anything to show that just yet. The next one there is mix of taxable and tax-free components. So look, we're waiting on just to see the finer details of this. Did you want to go into?
Yeah, we might go through that in a couple of minutes once we get to that one.
Yeah. Okay. So, and then the next one, obviously, the benefit of indexation is limited to the proportion of unused cap. I think we'll go through an example of that too. The amounts in accumulation will be subject to tax on earning up to 15% there. That's as Richard said, someone that may have had $2 million in their fund and have gone from all tax-free and they're now going to be subject to tax. Penalties for excess amounts. So, look, we self-managed super funds. We think it's going to be quite difficult for someone to actually to go over the cap. As we said before, it's an accounting entry. I guess it's going to be what we may not know about. So we're going to have to obviously sit down and have meetings with everyone just to see if there's any other superannuation sitting outside of the self-managed super fund. Even if it's just a tiny little bit, it's going to affect this.
And the sleeper there, of course, is defined benefit funds as well. I mean, we've got a few clients who might have a defined benefit fund, an old government fund, ESS or something like that, where they're receiving a pension from, and that doesn't have a dollar figure attached to its value. So we've got to do a calculation on how much that defined benefit is worth in relation to the $1.6 million cap. Yep. So that one I think is probably one that's going to sneak in occasionally. Yeah. So we don't expect people to be in excess. It's going to be pretty tough. But as Calvin said, it's the unknowns. So the funds that we as advisors aren't aware of that may inadvertently put somebody into excess. Yep. So communication is certainly key there.
It will be. Now the next one, there's inability to accept a reversionary pension. That will definitely go into more detail. That this cap may permit this to happen. Again, as Richard just discussed, pension withdrawals do not reduce your cap. So if you're only ever just taking out your minimum pension and your portion of your fund that's in accumulation versus in pension is going to change. So effectively, your fund may end up paying more and more tax as the years go on, which I think is an intended consequence, definitely. Yep. And that's the last one there. Investment losses do not impact your cap.
Yeah. All right, so let's take some of these in a bit more detail. I mean, the Centrelink one is an interesting one. Again, we talk about intended consequences and unintended consequences, and this one probably falls into the unintended, you would hope. Because it will affect a number of people who are on age pension and potentially those that are currently receiving full age pension. We've already run through the gauntlet of some changes from the 1st of January this year, but so they may also start seeing a cut in their age pension as a result of this transfer cap. So basically we've used an example here which is a reasonably typical example of a 65-year-old pensioner couple who receive or have a account-based pension in super of $375,000. That's their retirement nest egg, basically, that they're drawing a pension from. Now, in this case, that pension was commenced before the 1st of January 2015, and the relevance of that date is that the income for Centrelink purposes is assessed on a basis of their life expectancy, or the number of years of life expectancy remaining divided by their balance. So in many cases, no income is assessed from Centrelink's perspective. So in this case, the client would be receiving a full age pension under both the asset and income tests. Under this new legislation, where there is a requirement to roll back an account-based pension for the purposes of calculating a cap, arguably that means that the pension that was commenced 1st of January 2015 or prior to will have a new start date of the 1st of January 2017. And that, of course, will lead to that asset being assessed differently for income. And in this example would result in $65 a fortnight reduction in age pension. So which is quite severe given the Centrelink client certainly doesn't have the kind of balance that the government were talking about when they were building this legislation, but are indeed going to be impacted from a Centrelink perspective. Now, going back to another great philosopher, in Donald Rumsfeld, who talked about known knowns and unknown knowns and known unknowns and so forth, we put this one in the category of being a known unknown. We know it's a problem. We hope the government know it's a problem, but we are unsure yet as to whether or not they'll find a resolution so that this doesn't impact those that shouldn't be impacted in this process.
And I think one point to make there too, isn't there, Richard, that it's on the current low deeming rates as the economic environment changes and interest rates, eventually increase. It's potentially going to affect people even more.
That's right, because their income test will go up, and therefore they'll start receiving less pension again. So certainly one to watch. I think that's a hot issue yet to come out. The second is around an estate planning issue, and we go back to Scott Morrison insisting that superannuation isn't an estate planning tool. So he's certainly been true to his word here. Now, this one we'll try and explain as best we can, but we all, as members, have a taxable component of our superannuation balance and our tax-free component. Taxable generally is made up of your funds earnings and also any contributions that were either through tax deductible or salary sacrifice or even super guarantee. And your tax-free component is made up basically of after-tax contributions. Now, this doesn't mean a lot for us day to day. However, in the event of our death, if our beneficiary to our fund is a non-dependent, they will pay tax at 15% of the taxable amount. So potentially it's all wrapped up as basically a death tax in a lot of ways if you're leaving it to a non-dependent. Spouse is fine, no tax payable when you leave the spouse, but certainly if it's someone who perhaps doesn't have a spouse or spouse has already passed and we're passing to adult children, then certainly there may be a fair tax impost, given most of us accumulate super through salary sacrifice or super guarantee. So one of the strategies we've always engaged with is something called a recontribution strategy, where we effectively withdraw money out of superannuation, comes out of that taxable pile, and then we put it back in and it goes to the tax-free account effectively. All that does, again, it doesn't do you any favours particularly, but it certainly, in the event of your death, may reduce the amount of tax payable by your loved ones. And what we do as part of that is we keep the taxable and tax-free where we can. We keep them separate so we don't mix them together. And obviously the idea is to use up all the taxable in the first instance. Now, the difficulty with this transfer cap, as we said again, everything has to be rolled back. So if we've got a nice lump of tax-free pension account where our beneficiaries aren't going to pay any tax, and then we've got another one we might have a small amount of taxable, and then we might have an accumulation account which is all taxable, and we roll them back, effectively they're all going to get mixed in together. And once that happens, the resulting potential beneficiary tax is very high. So as an example to that, you can see here our 65-year-old retiree has 500,000 in pension, but he's got it in two accounts. One is a tax-free account. He's done his recontribution strategy, and it's 100% tax-free. So in the event of his death, when that passes to a non-dependent, they won't pay any tax on that 400,000. From that, he's drawing his 5% minimum pension, which is $20,000 per annum. On the other side, he's got a second pension account in the same fund for 100,000, but that's all taxable, so it's 0% tax-free. Now, because we want to get rid of our taxable amounts, we would draw the larger pension out of that account to effectively deplete it. So in rough terms, pension 2 on that basis would run out in about 3.5 years, and the tax liability for beneficiaries would be zero because we would be left with an account that was 100% tax-free. Now, the result of the new transfer cap is going to be that those two pension accounts are now going to be rolled back into one, which is going to still give us 500,000 in total pensions, but 80% of it will be tax-free and 20% will be taxable. So whenever we take out a pension amount, 80% of that pension is coming out of the tax-free and 20% is coming out of the taxable. So in 3.5 years, we will still have 80% of the balance tax-free and 20% taxable. So the beneficiaries will pay tax and become very, very difficult to change that situation. So again, $500,000, instead of paying 20% on the taxes, or 20% of the fund being taxable to the beneficiary, which is basically about $15,000, that's what the situation would be now versus potentially zero prior to these changes. So again, intended or unintended, it is a consequence that affects us all, not necessarily relating to the 1.6 million. Again, we're hoping the government are aware of this problem and will take some action from a regulatory point of view to make provisions so that we can avoid it happening. All right, indexation, I'm going to give this one to you, Carl, to cover.
Yep, so here we go. So from 1st of July, we're all going to start with a $1.6 million cap. In the proposed legislation, the government's got there for some room there for increases via indexation. So they've got there in $100,000 increments. So after, let's say, 3 years, the cap increases to 1.7 million. We've got a little example here just to, I guess, show you how this will work, because it's not as simple as just adding $100,000 to your unused cap. If you've already used all or a portion of your cap prior to indexation, you're going to be affected. So this example here, on the 1st of July 2017, $700,000 is used to commence a pension, or 43.75% of the cap, so there's $900,000 remaining. On the 1st of July 2020, the cap lifts to 1.7 as per the indexation and the $100,000 increase. So common sense means the available cap now would be 1 mil, because there was $900,000 unused plus the $100,000 increase. Unfortunately, that's not the case. They've covered their bases here. So the amount of the cap that was used was 43.75% as at 1st of July 2020. So there's 56.25% available. So instead of getting the full 100,000 using these calculations here, there's a 56.25% increase available. So therefore, instead of going from 900 to 1 mil, you're going to get that extra 56,250, making your available cap $956,250. So it's not a simple calculation of just adding the 100,000. And I guess the real silly thing here is that every single person is going to have a different cap, aren't they, Richard?
Yeah,
so from an ATO and from an administrator point of view, it's every single individual will have a different cap. So it's they've made something that could be simple, not simple.
Yeah, and in that example, obviously, he's only using 46% of the cap, so there's still a bit of room there. But obviously, there's another example here where someone's used 1.5 out of the 1.6. So basically, out of that 100 grand indexation, they're only going to get an extra 6 grand on their cap.
Yeah.
So virtually pointless. But of course, if you use 100% of your cap in the first year, so the client with the $2 million and rolls 1.6 in, then he's used 100% of his cap. So regardless of how many times the government increase the cap through indexation, that particular client is done and dusted, no more. Can't transfer any more over unless he pulls some out as a lump sum. But this one, next point around taxation of the amount over 1.6, and this is a reasonably straightforward circumstance. If you have a balance greater than 1.6 million, obviously only 1.6 can go into the tax-free pension, and any balance sits in accumulation. That balance is subject to earnings tax at a rate of 15% for income and 10% provided you've held the asset for more than 12 months on capital gain. So we won't spend a lot of time. That one's pretty straightforward. Not ideal, obviously, especially for those with the high balances. but we can certainly see what the government's trying to achieve there in minimising tax benefits within the fund. So there's a quick example of that in place with the $2 million balance. We've got 400,000 staying in accumulation because it's over the cap, and on the presumption that entire fund earning 150,000, 20% of that will be subject to tax, which is the accumulation proportion, which is going to result in about 4,500 tax payable. One solution, of course, we had for this prior to these changes was the ability to segregate assets, where we could choose which assets we're going to hold in pension and which ones we were going to choose to hold in accumulation. So we might hold an asset that doesn't produce an income, might be a growth asset in accumulation, while it's subject to tax. If it's not paying an income, there is no tax. And then the income asset being held in pension, where it's 0%. But unfortunately, the government got ahead of us there and have actually banned segregation from use from the 1st of July 17. So there goes that one. We've got an alternative, a possible alternative for clients who want to still or have a benefit of segregation in inverted commas, and that would be to set up or establish a second self-managed super fund, which would then hold those assets that potentially might be growth assets or ones with very low income, so term deposits and stuff like that, where the income is quite low, so then the tax consequence is smaller. But again, that's on a case-by-case basis, and we would look to individual circumstances before working out whether that was an appropriate action to take. Our excess amounts, now, Kel, this is interesting because I'm not sure how many people are going to get caught in this. I think it's going to be pretty difficult. We talked before about a couple of circumstances where it might occur, and probably more inadvertent than anything. But of course, probably the big concern is how long the government take before they're aware of an excess amount, and in the meantime, the person with the excess is actually subject to some penalties. So you want to run through those penalties?
Yep. So the example here. This is what's in front of us at the moment. Is that if you exceed the $1.6 million cap, the fund will be then taxed at 15% on notional earnings of that excess amount. The notional earnings rate currently is going to be the bank bill rate plus 7%. So in the current form, 8.78%. So let's say, for example, someone transferred $1.8 million instead of the 1.6. They're going to cop an excess amount penalty of $200,000 at the 8.78% at 15% tax rate. So $2,634. So I guess, let's just say this was for, we don't yet know how the mechanics are going to work with notifying the ATO, how quick they're going to find out that you've gone over the cap. So, because for instance, this might happen in July, and then you don't lodge your tax return till in some instances to the May of the following year. So if they're then going to take let's say 6 months to work this out, potentially you could have a couple of years here. And then again, they've said if you do it a second time around, they're going to tax it at 30%. So I guess the one big issue that sticks out is around the reversionary pensions. Here is you've got 12 months to rectify if you go over the cap with a reversionary. Sometimes it's difficult to wind up some assets inside a fund around when death occurs. So we're hoping they make some provisions there.
Yeah, that's right.
For that, but I can only see that's the only real reason why in a self-managed super fund you would have an excess amount.
Yeah, and certainly from a self-managed super fund, it would be very hard unless you've got more than one fund with more than one administrator. Would be very hard to go over because simply it's an accounting entry and it won't allow us to. But potentially, as I said, you've got the defined benefits, which may be a sleeper, and also for people who are in retail funds or industry funds with large balances, they may have more than one. And of course, CBUS, for example, wouldn't know what Colonial First State is doing and vice versa. So it may be more inadvertent. And as you said, though, that could take a long time before the client's notified of that. So again, advice is really important. But also the other sleeper, I think, is the penalty rate. While it's 8.78 is a fairly high notional earnings rate, keep in mind there the bank bill rate's only 1.78. Now, obviously, as interest rates rise, so will that. So it could, in fact, get quite steep going into the future. So certainly one to watch. But if you've got good communication with your advisors, then hopefully there shouldn't be a reason why anyone would breach that amount. You mentioned reversionary pensions before, so let's talk about that. Reversionary pensions obviously reasonably new in this system. Basically, what happens when a member passes is that the funds generally get paid out to the member outside of superannuation, but often the favourable outcome is that the funds remain inside superannuation, and that can be achieved through the use of a reversionary pension. However, the amount you receive will contribute towards or be counted towards the pension transfer cap. So if you've already got a reasonable balance and your reversionary pension coming in will put you over the cap, then you've got some steps you're going to need to take in order to prevent the excess amount going outside of super back into personal names. One of those options, of course, is that you could, by debiting your balance transfer cap by commuting your own pension back to accumulation and allowing the reversionary pension to flow through into your balance cap. And then, you could certainly roll back in any leftover cap you've got. Or obviously you could do a partial commutation of the reversionary amount if it was too high. So again, a bit of planning there if you know that you have a reversionary pension on its way. The government have granted 12-month period on that to be able to get that right. But I think that's probably all the concessions they're going to give us. And I think if you end up breaching, they will come down on you. Again, especially, let's keep in mind that that reversionary pension may be in another fund, may not be in your primary fund as well. So that all gets added towards the cap. So certainly one to watch. Still makes reversionary pensions very worthwhile, but just being aware of the consequences of that are important. This one is a really interesting one, which is the fact that when you draw a pension out of your pension account, it doesn't reduce your transfer balance. So if you're in the habit of drawing large amounts of pension out of your pension account, which is fair enough to fund your lifestyle, if your pension runs down to zero through that process, then you're not going to be able to transfer any more money to top up effectively your pension at all, because you'd have already used the cap. So, we've used an example there of someone who've used their 1.6 cap. They're drawing down 10% pension, 160,000 a year, and arguably, depending obviously on returns and things, the fund's going to run down in 10 years and then they're done from a pension point of view. Everything after that is taxable. So one suggestion, certainly one strategy, is to take a minimum pension, which is 5%, and then the balance you commute the 80,000 from the pension back to accumulation and withdraw it there. Now the result of that is you still get paid your 160,000, but in 10 years you've still got available cap of 800 because you've commuted 10 lots of 80,000. So certainly planning for the future from that point of view. It's all about how you call your payments that you receive out of super, and that applies to whether you're in a self-managed fund or whether you're in a retail fund. You might just need to go through a process with your retail fund about how you do that. Obviously through a self-managed fund it's a hell of a lot easier, but certainly something to keep in mind. So the impact of investment gains or losses, this is an interesting one, and I think one that has its pluses and minuses. Go.
Yeah, definitely. If in the good times, it's not going to impact you if it increases, but I guess one word that they really don't want to use anymore is GFC on the downside.
GFC, so 2009.
Yeah. So what they're using now is this terminology of a macroeconomic shock. There's nothing written there that in legislation that if something was to occur, and obviously we hope that doesn't occur, that they will make an amendment to the cap. So at the moment, as Richard said, if you were to draw down, $160,000 a year in 10 years' time, effectively you've used all your cap, and whatever's left over in accumulation will stay there. So even in the event of a macroeconomic shock, we don't even know what they may or may not do. So I guess at the moment we've just got to use what's in front of us. But I think the main point here is, assets supporting a pension could increase substantially. But on the other side, they could fall, and it's not a debit to the cap, unfortunately.
Okay, CGT relief. And this one is a really complex area, and one we're not going to go into in great detail because we would absolutely prefer you got advice on this, because it is an area which needs to be looked at on a case-by-case basis. So there's certainly no one size fits all solution here. So all we'll probably say on this is that the government, because the rollback of pensions to accumulation from the government's point of view is regarded as a CGT event. It is a nominal sale and purchase. There is a CGT impact. Now, this CGT impact can be deferred, shall we call it, through the resetting of some cost bases. So again, something to be aware of, but certainly if you are in the 1.6 million category, and it only applies to those with balances greater than that, is definitely to seek advice. So we'll leave that one there. Another sort of possible strategy here in terms of minimising your cap is to, where possible, if you've got a situation where a member of a couple, one with a high balance, one with a lower balance, is possibly to withdraw some out of the larger and recontribute it back to the member with the lower balance. Just to effectively increase the availability and the flexibility of the cap in the future. In addition to that, because you're making an after-tax contribution when the money goes back in, you could also reduce your taxable component, which links back to your beneficiaries, as we discussed earlier. Transition retirement, Cal. This is probably the biggest one from our point of view, which is going to impact the most clients. And for all the rhetoric that the government says that not many people will be adversely affected by these changes, I think we've demonstrated already that they're fairly far-reaching. Forget the 1.6 million. These changes are going to impact a lot of people. Yeah,
definitely. It's a huge amount of the population in this age bracket would have already commenced a transition to retirement income stream. So I guess what we'll do, we'll just run through what is a TRAP at the moment, a transition to retirement pension. So it's where you've met preservation age. So as Richard discussed previously, it's currently scaled from between 55 and 59 at the moment. We currently sit that it's at 56 years old and you're still working. You can commence a pension once that occurs, and you can take at the moment between 4 and 10% of that balance. So between the ages of 56 and 59, you pay tax on the taxable amount. So again, we're talking about the taxable and tax-free amounts in your pension. And then you get a 15% offset in your personal tax return. Obviously, please be mindful that age 60 to 64 do not pay tax on this pension. So it's not included in your tax return. You take the money out tax-free. And currently, assets and pension do not pay tax on earnings. So, your average fund in a transition to retirement would be, anywhere between, depending on the age of the other members, could be a high tax-free pension fund. But under these new rules, that's been taken away. And that's
a big thing, taking away that earnings tax exemption.
Yeah.
And that's where it'll impact people the most. The rules still allow for the for the pension to occur, but really taking away that is a real big incentive to doing this in the first place.
Yeah.
I mean, in terms of real dollars here, I mean, we've got an example where, you know, from the 1st of July, when they take away that benefit of not paying tax on earnings, that effectively, you know, on this example where the earnings of the fund were 20 grand for the year, now pay $3,000 in tax. So again, it's a fairly severe whack, and certainly those in the age 56 to 59 age group, we'd probably now question whether it's worth being in a transition retirement pension, because there's no real tax benefit anywhere. Certainly over 60, we certainly still advocate it, purely as a mechanism to getting more money through salary sacrifice. But you know, in that younger age group, it now becomes almost moot. So hopefully they keep that age 60 where it is and don't start pushing that one out. The other one that will affect a lot of people is a reduction in the contribution cap from $35,000 for over 50s and $30,000 for everybody else, down to $25,000 ongoing. So effectively talking about going back to the future, I mean, this was the amount that we all had 7 years ago in 2007 and probably before then. So, you know, in fact, we've had no indexation, and the value of that $25,000 is a lot less now than it was back 10 years ago. So this one's a real scratch my head kind of one. I mean, we're trying to encourage people to save for their retirement, but then we're limiting the amount that they can actually get into the fund and save. So it's a fairly short-sighted view. We understand why. It's so that people are paying more tax on their earnings rather than having the opportunity to salary sacrifice. So we get the tax receipt issue, but certainly it's a short-sighted view. You know, getting a quick result now, but with some long-term pain, I think, in cutting these abilities to save. Now, again, you know, in a typical situation, this is an unusual situation where we've got a 60-year-old employed person with $100,000 in income who's salary sacrificing at the moment, you know, 25 grand. So he's taken the $35,000 cap. He's saving a large amount of personal tax, in fact, a bit over $9,000 there. He pays a bit of contributions tax, obviously, but his total tax benefit through the salary sacrifice is $5,500. We fast forward to 1st of July 2017, because he can only now sacrifice $10,000 less, the amount he's saving personally has reduced from $9,000 odd now to $5,500. So his lost opportunity in tax savings is $2,300. Add to that the reduction or the elimination of savings on earnings tax in his pension. That same client now, with those two things combined, has got a financial impact of, you know, over $100 a week by these changes. So they're pretty severe in what we would regard as a fairly atypical situation for many of our clients in this age group who are desperately trying to top up their retirement savings before they do finish up. So that one's, yeah, fairly severe. Look, on the upside, we're not going to say the budget was all bad news. They have got these provision for catch-up concessional contributions. Carl, do you want to mention that?
Yeah, definitely. So this one here, they've introduced, I guess what we call, like, it's a 5-year rolling cap. It was meant to be from the 1st of July 2017. They've pushed that back 1 year on us. So I guess the main reason, you know, you would have read in the media that they've put this forward is for, you know, for those that may have very seasonal work, or mothers that may go on maternity leave or move to part-time for the first few years of their children's lives and may go back to work. They're actually going to be able to use some of that cap that they may not have been able to use while they're out of the workforce. So look, it's a big positive, I think. But what they've chucked in there now is this: it's subject to your superannuation balance being $500,000 or less on the previous financial year. So from a planning point of view, you know, we could see some difficulties here, because you won't know potentially what your balance is until, you know, you get all your financial accounts done.
So you may qualify for it in year one, but by
yeah.
the time you want to use it, your balance may have grown through
Exactly.
investment growth and so forth, and actually knock you out, and then the opportunity's gone.
Yeah, and a lot of these people that probably this would be subject to, might also have a few little funds lying around that may have been dormant or kept open for insurance purposes. That so again, it comes back to what we mentioned previously: the communication and making a meeting to sit down about this. It's going to be very important to making sure that we get this right.
Absolutely. We'll just whip through some of these last ones here. Our non-concessional cap, which is our after-tax contribution cap, which is currently $180,000, has been cut back to $100,000, which is a fairly big blow. I mean, that's nearly a 40% decrease in how much we can contribute to super and after-tax dollars. Again, a bit short-sighted on the government's part. Not allowing us to have the opportunity to save. We might get we all don't have that kind of money lying around, but we all, at the same time, things like inheritances or other windfalls that come in, not to be able to have those work as effectively as they can in something like superannuation is a bit disappointing. Be careful of because we currently have 180 and then next year is 100, just be careful of some of the transitional arrangements around the bring forward rule, which you may get caught in. So certainly if you're looking at making lump sums into superannuation that maybe exceed the current year's cap, which means you trigger the bring forward, then please seek some advice in relation to that as well, because you don't want to get caught contributing on an excess amount. The low income super contribution, this is a little bit of a nothing change. This is effectively the refund of contributions tax for those earning less than $37,000. Nothing really changed here other than the acronym. It went from a LISC to a LISTO, so no change there at all. The spouse superannuation contribution tax offset. So this one is where you can contribute after tax to a spouse's superannuation account up to $3,000. And the government will allow you an 18% tax offset. Now, currently that's limited to those spouses with income less than $13,800 and meet a work test. The income limit to that has been increased to up to $40,000 on a taper rate for people working. They've got to pass a work test. But look, not very often used, little known about it, but it is there. And now that the income threshold's been lifted, it's certainly available to a few more people. So that's a good thing. Cal, Div 293.
Yeah, so as mentioned earlier, this is the tax on your contributions when they actually go into the superannuation system. That currently sits at obviously 15% for everyone when it goes in. What the Div 293 tax was as an additional tax for those with an adjusted taxable income, plus your concessional contributions, which would total more than $300,000 per annum. The only thing that's changed from 1st of July for this one is that they've just reduced that from $300,000 down to $250,000. So again, they're opening up their scope to capture more people with this tax, and I believe it definitely will. So,
yeah, I mean certainly the average earnings has increased over time. So, 250,000 will capture a hell of a lot more people than what it did 5 years ago.
Yeah.
Now the eligibility, second last one on these, but the eligibility to claim a tax deduction for contributions. So. Previously, if you had a income from employment, so a group certificate basically of more than 10% of your total income, you're unable to claim a tax deduction for a superannuation contribution. You had to do it through your employer. That's now been, the 10% rule's now been taken away. So basically anybody who is working and generates an income can make a tax deductible contribution. They do not have to do it through salary sacrifice. So that helps a lot of employees whose employers don't allow salary sacrifice, which, believe it or not, still happens. or those that maybe are moving from self-employment to employment, or others with a number of different jobs that may involve some self-employed and some employed. So that's a good thing too. It opens up the ability for everybody to play by the same rules. It is for under 75, and as I said, you do have to be able to satisfy a work test, which incidentally is to work 40 hours in any 30-day period during the financial year, which is only about 1.5 hours a day, I think, to satisfy the test. So that's certainly, we view that as a positive. Anti-detriment provisions, as we said, was an allowance so that a super fund can effectively refund to a deceased member any contributions tax they paid during the year, or during their lifetime rather. As I said, used in very limited cases, and from a self-managed super fund perspective, the fund had to have set up a reserve of funds, often through earnings, to set aside for that occurrence. Those funds weren't allocated to any one member, but were available for use in the event of a member's death. So those provisions have now been taken away, but given their lack of use, that almost becomes an administrative thing. There's been some questions from clients around the small business CGT concessions and the new super caps. Just to be clear, there's no change to this. You can still contribute into super outside of all the caps. Your small business CGT concession amounts, which are up to 1.4 odd million. Just be careful though that if you are contributing in this way and you also want to contribute non-concessionals, that we would highly recommend you do non-concessionals first, because if you do put in a large sum from a CGT concession and your total balance is greater than 1.6, then your non-concessionals will be disallowed. So certainly be aware of that. Okay, so we're winding up here. Is the government putting a limit on how much we can contribute to super? Absolutely. Our deductible contributions have gone from 35,000 to 25,000, and our after tax from 180 to 100. And on top of that, they're also capping out, if you have a total balance, regardless of pension or accumulation, of 1.6 million, then you are unable to contribute any more in after tax dollars. You can still take advantage of the limit's $25,000 limit, but certainly you can't put any after tax dollars in. So absolutely they are capping out how much we can have in super, and it almost goes back to the old reasonable benefit limits that used to be in place many years ago. So that's about it, folks. In terms of some next steps, look, we highly recommend you get advice regardless of your situation. But certainly we would recommend you review your contributions, making sure you don't go over any of the new lower limits, especially in relation to the after tax where you may have triggered a bring forward, because you don't want to fall foul of any excess contributions. If you are planning to make contributions, please try and get it done before June 30 to take advantage of the higher cap. Check your eligibility for benefits such as the spouse contribution offset, as I said, with the extension of the income amount. Do some tax planning around your deductible contributions, given you can now make, even if you're employed, you can now make an end of year tax deductible contribution, and ensure where available your reversionary pensions are available and in place. From a superannuation point of view, self-managed superannuation point of view, your trustee is going to have to be updated to reflect these changes. As onerous as that is, we are negotiating with our solicitors now to build a new deed that complies with all the new rules, and we're hoping to obviously get this on a bulk basis so that we can reduce the cost to all of our self-managed super funds. So we'll certainly keep you in touch with that. More than likely, we're going to be March, April. Reversionary pensions, again, your deed has to make them available, and where appropriate, we'd certainly recommend putting them in place. And finally, your binding death nominations as well. A new trust deed means, or an updated trust deed needs, you have to have updated binding death nominations. So certainly that's got to happen. So most importantly, recommending you get advice. Ashford's Wealth Advisors are always here to answer any questions you might have, but please don't take any of what we've walked through today as being applicable to you. get the advice to make sure that it is appropriate. So we're obviously always available to our clients to have those discussions. If you have any questions along the way, as I said, please don't hesitate to give us a buzz. You can email us at either smsf@ashfords.com.au or wealth@ashfords.com.au. We'd be more than happy to come back to you with an appropriate response. We hope you got something out of today. It was long, but there's a lot of information in there, as much as which we have covered today as we possibly can. So thanks again. Thanks, Carl.
Thanks, Rich.